Welcome back, students. I'm explaining foreign exchange transactions. Now, when dealing with foreign exchange transactions, you need to know that when you are quoting the rand to a foreign currency or a foreign currency to a rand, which type of quotation is that? Here you'll see it says 1 rand equals to 50 cents in dollars. This is what we call an indirect quotation. You'll see they start with a rand this side, and then they say equals to a certain amount. Okay, if you purchase a vehicle for $10,000, you'll see here you divide by 0.5, it will then give you 20,000. Let's say this was 0.20, and you'll do the same here. It's 20, and that at 20 it will give us 50,000, isn't it? Now, right. So that one is called an indirect. You divide when you are dealing with an indirect. Okay, indirect. This one you divide. Now then we come to the second one, whereby you are saying $1 equals to 2 rand. This one we call it a direct quotation. You'll see the difference between the two. On this one, the rand is on the right hand side. On the first one, the rand is on the left hand side. Right. If you purchase a vehicle for $10,000 at 2 rand, for an example, it gives you 20,000. If this one was, for an example, 7, obviously you will multiply here by 7, and that will give you 70,000. 70,000 rands. Okay, so that is the first thing you need to know in terms of how do you do the quotations of this. Okay, all right. The quotations are two, indirect and direct. You must know the difference between the two. Now, then we come to this here. It says there are 3 dates when dealing with the foreign exchange transaction. We'll start by dealing with the first one, which is called a transaction date. Transaction date is when the risk and rewards associated with ownership pass from the seller to the buyer. So in short, if you are buying something, you want to know when do you start being responsible for it? When are the risks now lying with you? So every time when you're doing that, you read these are the 4 terms and conditions that people usually enter into when buying stuff. So the first one is free on board. Free on board says when you deliver over the ship's rail in the shipping country, meaning if I'm buying something from China, when my seller delivers my goods at the harbor in China, I start to be responsible as the buyer. I carry the risks and rewards that are associated with ownership. Now, you will see the second one called cost insurance freight. It says the same thing as FOB. If you look at the two, they are similar, right? The two. Again, if the terms are CIF, cost insurance freight, deliver over the ship's rail in the shipping country. So it means when the buyer drops off my stuff at the harbor in China or in the USA, I start to carry the risk. Okay. Then the next one is delivery duty paid. So here they're saying once my goods are delivered at the destination port, meaning if they're here in South Africa, let's say in Durban, and I've paid the import duties or customs duties. Now, what is key here is that you must pay the duties. On the date that you are paying the duties, the transaction date is that one. Okay. Then there is delivery at terminal. It says offloaded at the destination terminal in the buyer's country, meaning once they offload my goods from the ship here in Durban, I start to carry the risks. Okay. Now, again, here it says if there's no mention of the terms and conditions, of the above terms and conditions, then use the delivery date. So in short, we are saying if you are reading a question, you can't identify, you can't pick those 4. They are not there in the question. Then look at delivery date. That is the date when you assume the risk and rewards that are associated with ownership as the buyer, right? So just to demonstrate this thing in terms of an exercise, and what is very important is that you need to know that there can only be one transaction date. You can't have too many transaction dates. when for an example someone is writing and then they give us a transaction date on the first and give us a transaction date on the second, we don't care if one of them is correct. We just mark everything incorrect because we are guessing now. You need to know there's only one transaction date. Now let me demonstrate this with an exercise. Now here we look at this. On 1 January, you place an order for this at the USA company, right? You place an order of 100 baking machines at the price of $2,000. So it's not a transaction date, that one. You've just placed an order, nothing more, right? Now, in short, you've placed an order for $200,000, right? Now here, they are explaining that the shipping documentation states that the risk and return will pass to the buyer in terms of cost, insurance, freight. Now, here they are defining, they're giving us the terms and conditions. They're saying it's CIF. Then we come here, we say CIF says deliver over the ship's rail in the shipping country, meaning in that country where we're buying from. When they deliver the goods at the ship's rail, that is my transaction date. So this one, you do nothing. There's nothing. It's just the placement of an order. We come here. They're complete. They're ready for delivery. Nothing has happened. Still not transaction date. Then they're saying the baking machines were delivered over the ship's rail at the port of shipment. Here. This is your transaction date. You can only have one. 31 January 2017 is your transaction date. Now you come here, you check the rate on that day. Here is the rate on that day. Right. Then you recognize your asset here. We call it inventory because this person is selling these machines. Okay. This person is selling these machines. If you then look at this, the transaction here, I'm trying to click here, but you'll see the one here, the first journal entry, this one here, this one. You'll see here they are recognizing 200,000, 200,000 here. If you then look at it, you'll realize that it's 2 million because you are dividing here the 200,000. You can see you are dividing the 200,000 here. So debit inventory machinery, credit foreign loan, meaning you still have to pay this person. Okay. Now, that is CIF in terms of this. You'll see that there are a lot of dates that we give you here. Even here, we'll give you machine was offloaded. Here, it's not a transaction date because it's CIF. When it's offloaded, if this date, 15 February, would have been relevant if the terms and conditions were this one. It would have been relevant. It would have been the transaction date if it was DAT, this question. If this question was DAT, question 1, then obviously this date would have been the relevant transaction date. Okay, so let's look at this one. See, this one says the terms and conditions are these ones. DDP, delivery duty paid. Okay, what is delivery duty paid? Delivery duty paid here. Delivery at a destination port and import duties are paid. So we look at the date when the import duties are paid. Let's go to number 2. Again, here they will give you a lot of things. Pin ship, the cell phone on the right, fine. And then they are saying on 25, the container docked in South Africa. So it's here in South Africa. On 1 July, the containers were cleared from custom. That's the date we are looking for. 1 July. We come here. That's the date we are looking for. 1 July here. Okay, here's 1 July. So what then do we do? 1 July, $1 equals to 7 rand. Okay, $1 equals to 7 rand. Now, let's check. Right, the cell phones that you are buying, here is the purchase price. The total cost of these cell phones is $50,000. And 1 July is our transaction date when customs duties are paid. So it's 50,000 multiplied by 7, you see here. $1 equals to 7 rand and that date. So here's 50,000 multiplied by 7. It gives us this here, the debit. Anything that you buy for resale, if you buy something because you want to resell it, it becomes inventory in your hands, okay? So you see, that is the transaction date. So we've demonstrated DP and CIF. Let me check on this document that we gave you. So the first one is still the same thing, CIF. That's the same exercise that we're looking at. Here it's the DDP one. Let's see here. Still DDP on this one. On question, still DDP. Question 4. Question 5 is CIF. Here's DAT. Now, in this one, you'll see in question 6 they're saying it's DAT. Here is DAT. Now, DAT, we'll look at all these dates. 1 January, you're ordering nothing, you don't do anything. Be careful because these dates we give you so that some of you believe that you must use all the dates. It's not true. Some of the dates you just need to ignore. Completed here, ignore. There's nothing that has happened. Right. The machine was delivered over the ship's rail in the port of shipment. So it's in the US. That one is CIF or FOB. 21 January is CIF or FOB. So in this one, it's because we are dealing with the DAT. Due to the strike, the machine was offloaded on this date. You see, DAT, we look at the date when it was offloaded, isn't it? Now, you'll see when you look at the definitions that I've put here, DAT offloaded at a destination port, meaning here in South Africa. Okay, so now if that is the case, that means your transaction date is 1 February in this one. Then you go here, you look at 1 February, $1 equals to 650. Right, you bought something which is 100,000. So you'll multiply it by 650 because 1 February, it's 650, right? 100,000 times 650. So that is your question 6. Let's check here. I do have all the solutions here. Here is it. You see, it's 100,000. It's 650, what you bought here. Now, what you need to be careful of is that there can only be one transaction date. You can't have more than one. So that is your starting point. Okay. Now, we have dealt with this one, transaction date. Now, the next two dates, they interchange. One can come first. It's not always the case that number 2 is payment date. Sometimes payment date can be number 3, reporting can be number 2. They interchange. It depends on the question itself. Number 2, settlement / payment date, the date on which payment changes hands. We know that when you are paying someone, the cash will change hands. Then there's what we call reporting and / translation date, which is your year end, the financial end of the local entity, meaning you as a South African company, your year end is that date when you have to report all your transactions in it. So the transaction date is always number 1. But number 2 and 3, they can interchange. It depends on what the question says. Okay. Now, let's then deal with the question, this issue here on question 1. Right. We've already identified the transaction date here. Right. In question number 1. Right. Now, since we've identified the transaction date when we're dealing with this thing, okay, so which should have been this one as far as we're concerned, the transaction date. And at 31, it's 0.10. So because it's indirect, you divide. Okay. Then here in this exercise, they're saying to you, the baking machines here arrived in South Africa and must still be assembled before resale, meaning you must still put them together. And the cost is 2,000 each. And remember, you've got 100. At 2,000 each, must still assemble. Now, if you remember in PPE, we said any cost that you incur in bringing the asset into its working condition, it forms part of the asset itself, right? You will see here, we've recognized the assembly cost, right? Here, number 2, where it's 200,000, okay? This one here, where it is 200,000, right? The assembly cost is capitalized into inventory because that's how much you've paid, right? Then they're saying the baking machines will be sold at 20% markup on cost. Sometimes the markup can be on selling price, it can be on gross profit percentage, right? So you need to find out those two. How do you do it when it's those two? Right. On 31 December 2017, 30 baking machines had been sold. Right, have been sold. Now remember here we are doing 31 and 2018 December, okay, in terms of this one. So we're doing 2 years. So now, if 30 have been sold, you need to establish the cost price of one, so that you know that one cost me so much. If 30 were sold, they were sold at this rate, okay. Then it also says during the year 2017, 3 baking machines were returned to USA because they are faulty and had to be written off from the company's financial record, okay, right. So 3 had to be written off. Now let's establish the cost. Now look at the debit side of the first one. It's 2,000 here, meaning they are 2 million. Sorry, it's 2 million. So the 100 is there in that 2 million. Okay, they bought 100. But now don't forget the second assembly cost, because it costs 2,000 to assemble one. So these 100 machines, they cost 2.2 million because it's 2 million the first one, this one, and then it's 200,000 to assemble them. So in total, the 100 will cost me 2.2 million. Then you look at the journal entry here, this one here, where it says cost of sales. It says 30 divided by 100 because you've sold 30 here. It says so. You sold 30 here. Here you sold 30 out of the 100, right? So the cost of sales here, 30 divided by 100 times 2.2 million. 2.2 million, because if you look at the inventory, the first journal entry is 2 million. The inventory, the second, that has to do with assembly cost, is 200,000. So it gives you 2.2 million here in the cost of sales line. Okay, I'm trying to highlight, but I'm not sure why I'm unable to highlight here. Right, I've been trying to do that. But anyway, then you minus inventory at cost. Remember, this is the cost of sales. Okay, you are selling this. Okay, you are selling it. Then the next journal entry says 660, meaning extracted from the first one, the cost of sales of the first one, multiplied by 1 at 120. It gives you the sales of 792. You've sold 30. The cost of sales is the first one. Then the second one is the sales itself. Then let's then deal with the easy stuff for now. Let's go and look at this one here. This one here at the end here. The one that deals with, let me see. Yeah, it's this one. You see this one. Let's deal with this one, the write-off. You will see it says inventory return of 3 over 100. Those are the ones that were returned into the USA. Okay, they were returned into the USA. those three. They had to be written off from the inventory to basically reduce the number of items that we have. Now, what we then have to now look at is this. Since we said if you buy something, what can come first is the payment date or the translation date. Okay, so let's deal with that. Now, here they are saying, firstly, interest will be charged. We have not paid this gentleman, so we must pay 10% interest. Okay. And secondly, we are going to pay 100% of this thing, including interest, at 1 January. Now, here is this thing that I was telling you. 31 December, which is this one, will come before the payment, which is this one. So, in this exercise, this one is number 2. This one becomes number 3, this one, because the payment is after the year-end translation date. Now, the rule is that when you reach year-end and you find out that you have not paid a foreign creditor, you must restate the amount at the new rate. Okay, that is the rule. Okay, now let's then deal with the easy stuff first, the interest. You've got $200,000 at 10%. Now, the rule says you must use what we call an average rate. You'll see here. When you're dealing with interest, you use an average rate. You see here, 0.10 plus 0.2 divided by 2. Now, 0.10 comes from the transaction date. By the date when we are calculating interest here, which is 31 December, your rate at 31 December is this one here. You see, is 0.12. So, average rate is between two figures, this plus that divided by 2. That's what we call average. So, it's from transaction date, which is this one here, the 10, to the end, which is 31 December. So, you'll see here, they are saying 0.10, which is transaction date, plus 0.12, which is 31 December, divided by 2. Multiply by 11 over 12, because in terms of the months, right, you've recognized the asset here at 31 January. So if I have to calculate interest, I will start at February. From February until December, it's 11 months. So you will calculate it here at over 11 months. So it's very important to understand that when calculating interest using when we're calculating interest, you must use the average interest rate. Okay, so you have to do that, right? Now you've raised interest that you are owing to these people. Here it is, and you raised the foreign creditor that relates to it. Okay, now remember, by year end you have not paid this money here. See this foreign creditor that you raised here? It's not paid. The foreign creditor, it's not yet paid by 31 December. Then the rule says restate it at the new rate. Here you record it at 0.10. If they can say to you, pay now in December, if they can say pay it now in December, what are you going to do? You will pay it at 0.12 here. If they can say pay it now in December, it's 0.12, isn't it? But you raised it here at the beginning at 0.10. So you are gaining, because now let's try and translate this thing. How much is 200,000 at 0.12? Right, 200,000 divide by 0.12. It's 166,667. If they can say to you, it's 1.666 something, right? If they can say pay it now at 31 December 2017, pay the 200,000, you'll pay 1.666667. But when you raised it here, you are saying my creditor is 2 million. But if they can say pay it by December here, you'll pay this much, which is less now than 2 million. This amount is less than 2 million. So you've gained. You'll see here, there's a gain and of 300,000. Your creditor must be reduced by this much. So if I take 300 here, this 300, and I knock it off against this one, do you see how much is it? 2 million minus 123, 123. It's that 166 that I say you can pay. You have to pay now. You see that? So you'll see now you've got this one compared to this one. It's that 166 that you'll have to pay them. Now I've restated my creditor to a new amount that I'll be paying if they can say pay now. And there's a foreign exchange gain in that. Okay. Now let's deal with this one. We've raised an interest here. If they can say pay the interest now, let's check the rate. 2 divided by 2. So this one here, this average rate here, if I add the 2 here, these ones here, it gives me 0.11. So when we are raising the interest here, we are raising it at 0.11. But if they can say pay it now, if they can say pay this interest now, you'll have to pay it at 0.12. Right, at 0.12. So here they're expressing it for you. They're saying 20,000, which is 10% of 200,000. This one here, 10% of this is $20,000, which is this one here, divided by 0.12 times it. So this is how much you'll have to pay if they can say pay it now. Let's try and calculate it. To divide by 0.12 times 11 divided by 12. It's 152. It's this amount here. You have to pay 152 now at the current rate if they can say pay it. But now remember, how much did you raise? You raised 166, and you have to pay it at this rate, right? Now let's see, minus 166,667. You see, you are gaining the 13,000. 13 here. Okay, because you've raised this thing here at 166, but if they can say pay it now, you'll pay 152, which is lesser than the 166. So you are gaining money, right? We are gaining. Okay, now that is your transactions by 31 December, right? Now what then happens is, in terms of this question, they are saying the payment will be made here. Right, the payment. Here is the payment. It will be made at 1 January 2018. Now, if the payment is made at 1 January 2018, which is this one here, this one here, this is one of the most clustered transactions because we've lumped the outstanding 200,000 amount plus the interest. Let me show you. If I try to break down this journal entry, I'm going to break it down into individual amounts so that you can see it one by one. Here, let's start with the payment. Okay, let's start with the payment. We are paying 200,000 here. We are paying 200,000. I'm trying to fix this. Sometimes, okay, here we go. We are paying 200,000 here, right? As per the transaction itself here, right? It says you'll pay 100%, including the interest accrued. Okay. Now, and we know that we have not paid this 200. We raised the 200,000 here. By end of the year, we had not paid it here. We translated it into 0.12. Now, foreign exchange is like a relay. The 0.10 that you raise here, since you are not is still outstanding at the end, it gives it to this one. It's just like a relay. 0.10 will give it to 0.12. Okay. Now, at payment date, when you are making the payment at 1 January, here it is, the rate is 0.05. Right. You made a payment, meaning you are paying 4,000. But what are you paying? According to the relay that I was saying to you now, the 200,000 is sitting here at 0.12, is this one here. It's sitting at 0.12 now. It's no longer at 0.10 because 0.10 gives it to 0.12. And you account for the movement between 0.10 and 0.12. And then the new figure is at 0.12. Right. Now, you are paying a foreign creditor that is sitting at 0.12, which gives you this 166, the one that we calculated. How much did you pay? You paid this much, which is 4 million. Right, 4 million. This one. Your loss is the one in the middle. Now, what are you comparing? I'm comparing 200,000 at 0.12, meaning by year end last year, which is 2017. But now, if they can say I must pay it at this much, I've lost money, which is 2.3 million, 2.333 million. Right. Now, what is the next thing that I have not paid? I have not paid this interest here. I've raised interest here at 0.11. And by year end, I had not paid it here. What took over is 0.12. I had not paid it. I accounted for the gain. I had not paid this thing. So now I must pay 18.30 at 0.15, meaning the interest that we accounted for here in dollars here. How much is this thing? Let's calculate this thing here. It's $20. $20 times 11 divided by 12. Yeah, if you take the 20 times by 11 over 12, it will give you this one, the 18 that you see. You can see the 18 here, even here we are using it, right? So we are paying 18 at 0.05. Okay, so that is the payment. Now I'm dealing with interest now. The 18 at 0.12 gives me 152,775. Okay, so now I'm paying something which is 152,775, but I'm paying 366.60. Okay, now I've got a foreign exchange loss because something that is recorded at year end at 18 0.12. Now if I have to pay it, I'll have to pay it at this much, right? At this much, which means I've lost 213,885. Now this journal entry that I've done here, this one here, is the same as this thing here. This one is the same as this one that I've put here, where I said, oh, these two underneath here. You can see, for an example, if you say 4 million plus 366, it gives you this one. This one is a bit clustered. We've combined the two into one. Here I've showed you that we can split them into two so that you can see that the first one here relates to the 200,000 that we have not paid. The second one relates to the interest that we have not paid. Okay, so this exercise basically goes in that way, in terms of you understanding what do you do when you're dealing with this thing of a foreign creditor. So the second one here, it relates to direct quotation. It's not a difficult one, this one. Now on this one, what I can then basically show you is that it is still the same as the first one. You can see here 1%, you are writing 1% off of the cost. You are selling 50% of the cost and you get 175. Then you add the markup of 30% to sell. It's more or less the same thing. But what is key that I want to show you here is that you see, when we are dealing with interest calculation, you multiply with an average rate. Okay, you multiply with an average rate. And what I've then done is I've split this transaction here, this whole transaction here. I've splitted it into two to show you that you can put this way. Okay, you can put this way. In effect, what I should have done here is not to expand it this way, because now I'm repeating the same transactions at the top and people will get confused when you are doing that. Okay, so let me try and do this. 35 is then, let me try and break down the last transaction, which is, let me do this so you can see delete rows. Right, good. Now you can see what I've done is I tried to do a breakdown. Let me put it like this so we don't have too many pages. You see this one here, it's the 36 here plus 360. So I'm showing you that I can break down this, because here we've combined the capital amount that is not paid, that at the end of that time, at that year, so we paid it. So it's the capital amount and the interest. So here's the interest and the exchange rate that relates to it. Here it is the payment of the 50,000. Okay, now if we are dealing with this thing here, it's not basically complicated, but now let's just maybe break down so that we can break down this thing. It's 50,000 this, right, that we are buying. It's DDP. It's 1 July, because the clearance are there. Here's 7 rand. Now 50 times 7, here we go. The cost is, you sold 50% of that at a markup of 130. Right, you need to write off 1% of that. Now, where I'm going, I want to show you in terms of this, right? So since the year end in terms of this one is June, right, it's June here, you have to calculate interest. You can see here the interest is here, 10%. You see it says multiply by 7 plus 720. You see your transaction date, it was 7. But by 30 June, it should be, here's 30 June, yeah, 720. You divide it by 2, because it says when you're calculating interest, you calculate it at an average rate, right? You multiply that, sorry, you say this plus this divided by 2, you calculate your interest and you get it here. Then now this, in this exercise, the nicest thing is that it says interest is calculated, you can say 10%, and then the payment, paid total amount outstanding by year end. So there's no translation in this one, because the amount will be paid by year end. Now at year end, you'll pay the 50 that you raised here, you pay it, but you are paying it at 720. Here it is, right? And what are you paying? I'm paying a 50 that I raised at 7, but now it is costing me 720, so I'm losing 20 cents in between, which is my loss here, right? The interest, I raised the interest at 35 here, and meaning, what is the average rate? The 7 plus 720 divided by 2, it's 710. So I've raised this thing at 710. This is 710, right? If they can say pay now, I'm supposed to pay it at 720, do you see? So which means I'm paying an interest that is at 710, but I'm paying it at 720. I'm losing 10 cents in between, right? Which is this one. I'm losing the 10 cents in between, right? So it gives me the 500. So I've tried also in this exercise to break down this journal entry into 2 to show you that you are dealing with the 5,000 of interest and the payment of 50, right? So I hope this will assist you in dealing with foreign exchange.